Today we will talk about a key factor that traders need to know before they are taking a prop firm challenge such as FTMO or MyForexFunds. So this key factor is the reason why most traders fail the challenge and why the pass rate is lower than 5%. This is the reason why traders get lucky one month, why they get unlucky the next month, why they pass their challenge, why they fail their verification, or if they actually get funded, this is the reason why they lose the account after getting funded. So first, let's go over the actual requirements of FTMO or MyForexFunds. So we know that the profit target is around 8 to 10% for the first month, and then the next stage is a 4 to 5% profit target, and you have 60 days. So for FTMO, for example, there is a two-step challenge. The first step is a 30-day 10% profit target, and then we have a 60-day 5% profit target. If you want to get funded with FTMO, link will be in the description, definitely check it out. So the reason why most traders fail with these challenges and in trading in general is because of different market conditions. So we have three main market conditions. We have the trending condition, we have the range bound condition, and we have the volatile condition. And you need to adapt your strategy to the market condition. Your strategy will not work each month, so I would say it is not actually possible to pass FTMO or MyForexFunds each month, but if you time everything right, you should be able to pass most of the time. Again, I would say there are three types of strategies. There is a trend trading strategy, there is a range trading strategy, and there is a news trading strategy, which actually clicks with the volatile phase of the market. So the trend trading strategy is what I use. I am a trend trader. I trade only on the 1 hour chart. I look for moves up, I look for moves down, I look to get in on that trend, and I'm a trend follower. The next one is the range bound strategy, where you're selling the top of the range or buying the bottom of the range. Price is just moving from the low of the channel to the high of the channel, and you're making profits in these moves between. And the third one is again a news trading strategy, where you benefit from a lot of volatility in the markets. During news, there are usually huge moves with around 200, maybe even 300 pips on the Japanese pairs. So some traders focus on only trading the news because they know there will be a lot of volatility, a lot of movement, and a lot of opportunity. So you need to pick a market condition that suits your personality, and you need to find a strategy that fits that market condition. As I said, I like to trade the trend. That's why I found a trend trading strategy. What is really important is that these conditions can last anywhere from 1 month, 3 months, maybe even more. So range bound markets can last for a really long time. I saw a statistic that the market is ranging 70% of the time and trending only 30% of the time. So if you're a trend trader, guess what? You're going to wait a lot. And as we mentioned earlier, so FTMO usually takes 30 days for the first challenge, 60 days for the second challenge. And in that period, the market conditions can definitely switch. So it is really important to start your challenge when the market conditions are the best and to give yourself the best probabilities and possibilities to pass. So you need to do a lot of research. You need to learn how to spot a trending condition, a range bound condition, or a volatile condition. You need to time your entries. You need to time the start of your challenge, because a 10% profit target is huge. So you want to give yourself the best chance to succeed. In my experience, for the strategy that I trade, usually in a year there are maybe 3 or 4 months that are really trending and you get a lot of opportunities. The rest are kind of range bound with some little trends, but again, the market is range bound most of the time. So if I'm trading each month, taking a lot of trades, I'm going to be in a lot of losses. I'm going to get caught in a lot of ranges unless I learn how to spot those ranges. That's why most traders fail. So their strategy works 1 month and then it doesn't work the next month because the market conditions change. There may be a trend trader, and then after 1 month of very good trades and very good trends, the market condition switches to a range bound one. They don't notice this because they don't know the difference between a trending market condition and a range bound market condition. So they just keep trading, they keep taking trades, and then they take a lot of losses. They fail their challenge, or they fail their verification, or they actually fail their live account. So how do you actually learn to spot different market conditions, and how do you give yourself the best chance to pass? Well, you do a lot of backtesting. In your backtesting, you will definitely spot these market conditions. You will learn how to distinguish a trend from a range, from a volatile news candle, and you will also see which months work best for your strategy and which months perform the worst for your strategy. For example, I trade only on the 1 hour chart, and I backtested the last 5 years, and I learned that usually November and December bring pretty low results in terms of percentage. That's why I'm personally waiting for January, February, and March to start another prop firm challenge, because from my backtesting, I know that usually Q1, so January, February, and March, gives some nice trends and brings some good percentage. But I will also wait to see the evidence. I will only start trading once I see that the market conditions are right and that the market has started to trend. If the market condition is clearly range bound, I will be more patient and I will wait to start the challenge. So my advice is do a lot of backtesting. With time and experience, you will start to notice the difference between these conditions, and in your backtesting you will learn which months are the best, which months are the worst. I would recommend at least doing the last 5 years, so 2018, 19, 2020, 2021 and 2022. That should give you a clear picture of when is the best time to take a challenge, and then you just wait for everything to line up in the live markets, and then you can start your challenge. Again, trading is a game of huge patience. You really need to wait for the best time to trade for your strategy, and you need to wait for those perfect setups if you want to pass these prop firm requirements. Again, 10% in 30 days and then 5% in 60 days is a lot. So let's now go to TradingView and I will show you a real life example of a trending market condition, of a range bound market condition, and of a volatile market condition. Let's go. This is our first example. So this is the Aussie and the US dollar. It happened on the 22nd of April of 2022. So this is a really nice downtrend. You can see these legs look really nice. The pullbacks are really small. There are little to no wicks. You can see the candles usually have a clean close, which means a really small wick or even no wick on the bottom. And again, there was an entry right here on a break and retest trade, but that doesn't really matter. It would have banked a lot of percentage. So that's one example how us trend traders spot the market condition that is trending, and then we know to take trades. So again, just look at this. Look at the legs down. Look at the strength to the downside. Look if there is any bullish momentum to the upside. Are there any blue candles? Well, there are, but they're really small, especially compared to the bearish candles. You can really see that there are almost no buyers in this market. And when you see this good of a trending market condition, well, you definitely know that any opportunity that happens will be high probability to continue to the downside. Again, another good downtrend. This is on the pound and US dollar. This one happened on the 19th of August 2022. So really fresh price action. Again, you can see the legs to the downside look really strong. There is almost no momentum in the pullbacks, no bullish momentum at least, and the price just keeps continuing to a downside. In this case, there was a break and retest entry right here. If you first saw that the market condition has clearly switched to a downtrend, you would then look for an opportunity to sell right here. You would get in on this nice break and retest and you would make a lot of percentage. So I would say a trending market is really easy to spot, but what is hard is distinguishing a trending market from a range bound market. Okay, we can now take a look at the buy trade. This one happened on the 7th of September 2022. This is the euro and the Japanese yen. You can see, just look at these legs to the upside, huge momentum. Then we go down, but we continue with large momentum. We go down, but we continue. We go down, but we continue. And again, momentum continues to the upside right here. So for this one, the trade was another break and retest right here. So first you would have seen these market conditions. You would have seen clear momentum to the upside. You would have seen large blue candles, almost no wicks on top of these candles. Another really good sign that the price is ready to continue to the upside. And then you would have gotten in on this break and retest entry and you would have banked some nice percentage. So these are all examples of a really nice uptrend or a really nice downtrend. And we as trend traders look for exactly this. We look for large momentum to the upside or large momentum to the downside. And if we're looking to buy, we want to see that the strength to the downside is really low. So we want to see that the buyers are clearly winning. In this case, you can definitely see that the buyers are stronger than the sellers. Okay, so now you're probably wondering, well, how does a range look like? Well, here it is. This is the euro and the US dollar. This is on the 20th of July 2022. This is a clear range bound market condition. The euro and the US dollar likes to range for a really long time, so on this pair you will definitely see a lot of range bound market conditions. So here is our range right here. You can see loads of wicks to the upside, loads of wicks to the downside. We did zoom out a bit just for you to see more clearly, and basically the strategy here would be, well, buy the bottom of the range, sell the top of the range and make money. So for example, you could have potentially sold right here, made some money. You could have bought down here, also made some money, and the range extends. So again, you could have bought right here, bought again right here, potentially sold at the top in this area. So I would say the euro and the US dollar is really good to trade if you're trading the range. A telltale sign of a range is no consecutive blue or red candles with large momentum. So basically we'll be seeing a lot of V reversals. For example, this one, this one right here, and look how the price came down here, reversed straight back up. But again, in this move, there is not a lot of conviction. And another telltale sign is huge wicks to the upside and huge wicks to the downside. And you can just see if you're trading the trend and you get caught up with buying or selling in this area, of course you will get stopped out a lot. That is exactly what the market makers want. They want to stop you out. They want to build their positions. The bottom and the top of the range are huge liquidity areas, so there are a lot of stops here because the traders that are trading the range, they're going long in this area, keeping their stops below, or going short in this area, keeping their stops above. So just one tip, if you're a trend trader, be very careful when the price actually breaks out of the range, because it can very easily retrace back into the range because the market makers are just grabbing the liquidity and filling up their positions. So be really careful what happens in these areas if you're a trend trader. Again, another good example on the euro and the US dollar. This is around the 23rd of December 2021. And just look at this. If you're a trend trader, do you want to be buying or selling in this price action? Definitely not. But if you're a range-bound trader, well, then you're buying the bottom of this range and you're potentially selling the top of the range. Just to remind you, this is all on the 1 hour chart because I trade only the 1 hour chart for the trading strategy. But this happens on all time frames, so it's very easy to spot on all time frames. So yeah, if you're buying the bottom of the range, you would potentially buy here, make some nice profit. Or you can also sell the top, maybe here, maybe right here. It all depends on your personal strategy, but it's really important to notice when the market conditions are changing so that you can stop trading and of course avoid the losses. Here's another example. This is on the euro and Japanese yen. This is the 2nd of May 2022. Just look at this price action. There is no clear movement to the upside or to the downside. There are no clear consecutive bullish or bearish candles. Loads of wicks everywhere. Just look at those wicks. Look at the size of the wicks. They're really huge. And well, if you're a range-bound trader, you could be buying the bottom of this structure and you could be selling the top. So you would have your buy orders somewhere around here, buying, or you would have your sell orders maybe right here, maybe right here, maybe right here, and you could be betting on the price to return to the mean. So the mean is actually the middle of the range. So you're basically buying the bottom, selling the top, and betting that the price will go to the center of the range. So that's a very easy strategy, but the hard part is spotting a range and spotting the right market condition, being patient when you need to be patient, and being aggressive and actually taking trades when the right time comes. Okay, so let's now take a look at the final market condition, and that is the volatile market condition. Now, volatile market condition is usually distinguished with huge wicks and huge moves, so huge candles. Again, this is only on the 1 hour chart, but just look at this move right here. It sort of just went down and then retraced back up. You can see the size of the wicks, so let's measure this. This candle is actually 120 pips. This wick is around 80 pips, and then this move to the downside is around 285 pips. I mean, just look at the size of this move and then look at the size of this wick right here. It's around 200 pips, maybe even more. Just compare the size of these candles to the candles prior. So if you're trading the trend or if you're trading the range, do you want to be inside of this huge volatile move, or do you want to be trading after this huge volatile move? I would guess not, because if you're like me, if you have a fixed stop loss of, let's say, 12 pips, well, guess what? You're going to get stopped out a lot and you will lose a lot of percentage. So it's really important to us to either spot these moves in the market. For me, I now find it very easy to spot these candles and to know when to sit out when there is huge volatility in the markets. Or you can actually look at the fundamentals, look at when the news are coming out, and then you know not to be trading in that news period. After a huge news event or after a huge volatile candle, again, we can start ranging. That is pretty normal. You need to see if this type of price action actually fits your range trading strategy. But I would definitely recommend either extending your stops or waiting for the price to die down a bit. Again, you can see that then the price started to become a little bit quieter. The moves started to become much smaller, so then your stop loss would look okay once again. Another example on the euro and the Japanese yen. This one was on the 22nd of September 2022. So you can just see the size of this huge red candle. I mean, just compare it to prior candles. The average movement would be around maybe 40-50 pips per candle, and then you have this one, which is, let me see, so 323 pips. And then the wick, let's measure the wick. So it is around 115 pips. Those are the key characteristics of a volatile market: a huge candle and then no continuation, and a huge wick, showing us a volatile market and showing us that the price is very erratic. And look what happens after a huge news candle. So we usually start ranging. We usually get a very wide and flat range. This can be exploited, but you need to backtest it and you need to see what happens most of the time after you see these huge candles in the market. And for those traders actually trading the news and waiting for the news to come out, well, maybe they sold right here and then they closed their position right here. You never know. Maybe they have a certain strategy or certain insights. So before the news comes out, they actually have an order on in the market and they know exactly where they will exit or where their stop loss is. So again, you have a whole other section of traders only trading news events and making huge percentage from these huge moves. For me, when I see a huge move like this, I'm definitely being more patient and I'm staying out of the market. I'm waiting for the market to pick a direction and for the volatility to die down a bit. Next one, this one is on the pound. This happened on the 26th of September 2022, and you can just see the huge move, the huge candle. We can measure it right now. So let's see. It's around 400 pip moves. So the pound really lost a lot of strength against the US dollar. And you can just see what happened after the move. Obviously, we got overextended and the price was ready for a correction. And we can also see what would have happened if you have had maybe 15 stop loss. So on the pound, I use only a 15 pip stop loss. Well, you would have easily been stopped out. But again, maybe some traders were prepared for this move. They were anticipating it. So maybe at the market open, so the market opened with this gap. So let's say then some traders sold right here. And let's say they maybe closed somewhere around here, they would have made some nice profits. So again, you have some traders anticipating the news or actually looking at the fundamentals and expecting this volatile price action. And they're quickly just in and out of the market. They're waiting for a huge move and then they close their position. So that would be it. Now you know what to look for in the markets. You know what to look for in your backtesting. Find out what market condition is right for you and then learn to distinguish that market condition from the other types of conditions. This is the main reason why most traders fail. Their strategy works for 1 month and then the market conditions switch. Guess what? They start taking a lot of losses. They abandon the strategy. They pick another strategy. They maybe start winning for 1 or 2 months. Market conditions switch again and again they start taking a lot of losses, but they don't even know the reason why that is happening because they do not understand how the market flows from one condition into the other. For those of you that are waiting for the market condition to shift, maybe you have not had many trades in the past week, month, or maybe even 2 or 3 months. Just remember this: the market will never stay in one market condition. It always switches from a trend to a range to a volatile condition, because if one condition lasted forever, well, then everyone would be trading that market condition forever, and we all know that just is not possible and it doesn't work. So be patient, the market will shift and your strategy will once again start working. So just don't overtrade, follow your plan, and patience is key. The most patient traders are the most profitable traders. The best traders only make money in certain months of the year. They may make all of their money at the beginning of the year, or they may make all of their money at the end of the year, but they're definitely waiting for those best months, and they know not to expect to get maybe 25 or 30% month every single month. So that's it for the video. If you guys are interested in one-on-one coaching calls, link is in the description. Go to my website, make sure you book a call. Like this video, subscribe to the channel, check out my other content. I do post some other interesting videos, and I will see you guys in the next one.